Good day, viewers. Welcome to yet another episode of Analyst Insights, and I'm your host, Tavonga Njaya. And we are joined by our usual guests, who are Rufaro and Rangamakwat. Welcome, gentlemen.
Thanks, Tavonga.
In this episode, we'll take a look at the overall performance of the market in the past 6 months, as well as other developments that have happened in the economy. So my first question directed to Rufaro. We have seen the central bank issue a $50 note. Can you comment to that development?
Yeah, well, we've got a local currency.
Yes.
And we've had notes. They were initially called bond notes, but now they're just notes.
Yeah.
And the availability of this note is not really going to change anything, in my opinion, because to the extent that the fiscus has been involved in printing or increasing money supply and debasing the currency, this has been done electronically, and the denomination, this $50 note, at official rate, it's less than US $1.
Yeah.
And if they're going to be consistent with the way they have issued this paper money over the last few years, there's not going to be enough of them to go around. They're going to be quite disciplined about how much they issue in this denomination. So I think from the perspective of inflation or the ZSE or the economy at large, it's not going to have a significant impact one way or the other.
Maybe to add on, with regards to transacting, how significant is it? Ranga adds his view.
Thanks so much. So if you use an official exchange rate, this is more like $4 million US worth. They are planning to issue about 360 million a local currency of this new note, which is equivalent to almost $4 million US. If you use the para market rate of 130, you are looking at a number of around 2.7 million. So it just tells you that if they stick to limited issuance of the currency, it won't be of any significance. And like what Rufara has said, the $50 note is worth what? Between 37 cents to 60 cents US, depending on the rate that you use. And to have that as your highest denomination, it vexes. In mind, they say, okay, what could be the motivation? And when you look at where the narratives that are actually that have been coming out, that inflation is now under control, you'd think that maybe having a high denominated note was probably the least of our worries at the moment, because anyway, if inflation is coming down, it tells you that whatever notes that are there should be adequate in terms of being able to be available for transacting. But I think the dilemma that they have is, on one hand, they're trying to limit the stock of money in the economy, but on the other hand, there's pressure to demonstrate that we've got a local currency that is in circulation and that it has to be available. I don't think even the planned issuance will have a big impact given the level of transaction that is taking place. And the question is, I think we need to ask, do we really need to have pushing hard in terms of having new currencies, or maybe we should take advantage of technologies to push for cashless society, and also the fact that generally the economy has become predominantly US dollar denominated. Why would you go the full length of trying to issue a new currency? Much as it is insignificant in terms of the quantum, it's the signaling effect is not good. It just tells you that maybe you are saying the currencies, the notes that we have failed, or maybe are not sufficient enough to cover to meet the level of inflation that we have. In an environment where you're saying inflation is being controlled, it's sort of contradictory. So in a lower inflation environment, you expect maybe lower denominated notes, and you have to choose between either going straight for issuing enough notes for you to be able to for the economy to be able to transact, or maybe just go towards a cashless society. So these are like confusing kind of signals that are coming from the authorities.
Okay, maybe a follow-up to that. The public might be wary of that because they worry that perhaps the lower notes might be rejected. Maybe Rufaro, you can comment to that.
Look, I think not so much that the lower notes are going to be rejected. I think that their utility decreases over time because of inflation.
Yes.
So, and this is an obvious concern regarding this new note, to say what is its value going to be this time next year. It might be worthless, and you might need to carry bags of it to transact. So again, in the context of a macroeconomic environment that's hyperinflationary, does it make sense to be issuing such low denomination notes? Because I suspect that the cost per note is probably a few cents. And if we see inflation carry on at these levels, by this time next year, it will actually cost more to print that note than the face value of the note, which doesn't make any sense. And this has been true with prior issues of bond notes and the lower denomination notes currently in circulation. So I think the actual size of this note is disappointing. I think it would make more sense to have a note closer to the value of $5 or $10 US. Then you have some sort of guarantee that the note is going to remain relevant at least for the next 24 to 36 months. Whereas with this particular size, it's unclear whether that note will be relevant 12 months from now.
Okay, thank you. Still on the same note of announcements, the government has issued another pronouncement with regards to the lockdown measures that is now putting into action the past measures of last year of exemption letters. So maybe in 1 minute or 2 minutes, can we just comment to that effect?
No, thanks so much. So this is just a follow-up to the announcement that we saw in the last few weeks. But then maybe the question is, was it the best option available?
Yes.
Obviously, the numbers in terms of COVID infections and also deaths are increasing. But is that the best? Is maybe resorting to asking people to have exemption letters the best option? Are we saying maybe when we had exemption letters, we saw some, there was meaningful progress that was achieved in terms of containing the pandemic? I think what that will do is it will just curtail movement, even for people who are genuinely out to make a living, whether they're selling, their vendors, or people going about their own business, and just create another pocket for option for corruption, if I could put it that way, where someone would have to pay something to get through, whether it's a roadblock or whatever controls that will be put in place by the authorities. So I think that maybe they are better. I mean, this is happening at a time when the rest of the world is opening up. I mean, in the UK, for example, where they're saying they're going to be getting rid of all restrictions by end of July. I think what we needed to ask ourselves is, how did they come to that stage? Yeah. And vaccination is, for me, it has to be the target. You don't have to put the whole economy on ice because of this pandemic. You just need to push our vaccination numbers and make sure that maybe in the next 6 months we are joining the rest of the of the world, or some of the countries that have already moving away from any form of restriction. So I think there are better ways of managing the situation as opposed to resorting to exemption letters.
Yeah, so if I could just add, I think that I agree with everything that Ranga said, but I think that from So from an analyst or business perspective, we just need to resign and accept the reality that whenever there's a new wave of COVID, our government is going to resort to the same tools that they've used before. So we're going back to measures that we adopted in March last year. And to be fair, even the South Africans are in a level 4 lockdown. They have not been able to evolve or adapt or change their approach. They seem to be stuck to using the same tools. And I think that's our reality. I don't think it's going to change. I think that whenever we see an uptick in cases, hospitalizations and deaths, these are the measures that our governments are going to take. So it's bad for business, obviously, but that's our reality. I think COVID, the back of it really for us in this part of the world will be probably Q4 this year or Q1 next year, when the world's capacity for production of vaccines and delivery to the West has, when the West is basically at almost 100% penetration, and all the production coming out of the big pharmaceutical companies does not have a destination in the West. I think eventually there will be a flood of vaccines to this part of the world, and we will then be able to reach 70-80% plus vaccination penetration. And I suspect that's when this pandemic will be behind us permanently.
On that note, we're going to take a break. Please stay tuned for the next segment. Thank you for staying tuned. Moving on to our next question, which is directed to Rufaro. There have been reports with regards to Ghana raising about 2 billion in social bonds. Can you comment as to why Zimbabwe is not following, or what lessons we can learn as Zimbabwe?
Okay, so I think the global capital markets are huge.
Yes.
And in the context of the size of the global fixed income market, $2 billion is really a drop in the ocean. And Ghana is just taking advantage of these markets to raise $2 billion to fund some developmental issues. And I think Zimbabwe is in a perfect position to follow suit and raise billions of dollars on global capital markets. The reason why we have not done so is because we have a exchange control regime that doesn't make sense to most global capital market participants. So as long as it's not clear how the system works, whether they'll be able to move their money out once they bring it into the country, they're not even going to think about placing money here. So I think what's happening in Ghana really should be an inspiration and cause for reflection in terms of our policymakers thinking to say, look, what are they doing differently over there that we can adopt, that will make us, that will put us in a position where, like Ghana, we can raise money on global financial markets.
Sorry, Ranga can add his view, but also mentioning maybe what has happened on the local capital market in the last 6 months.
Thanks so much, Tawonga. So I think I just want to talk about the impact of our failure to raise money on the international capital markets. That we already have got a backlog in terms of infrastructure that we need to put in place. Like look at the state of our roads, the water reticulation, and even just the general infrastructure that is critical to support economic activity is just not in the right shape. And I think he is certainly, of all the things that we maybe need to be focusing on, we need to try and get some lessons from other African countries that are able to attract investment into their country. I think it's not feasible what you are trying to do to develop infrastructure using internal resources, because we don't have the internal resources. So we end up resorting to printing money, to creating money, to undertake infrastructure project, and it comes with huge costs in terms of having high inflation and also sometimes a currency that is very weak. Just look at the beauty of utilizing international capital markets in terms of some of the projects that have occurred in the last few years ago. For example, when the Plantry Mutare Road was done, and the fact that it was being funded by some developmental project financing outfits, it sort of lessened the burden. It doesn't come as an inflationary kind of project compared to a scenario where maybe we have to do Babri Churundo on our own, obviously because we don't have access to the international capital markets. So it certainly has to be an area of focus, and ask ourselves some very difficult questions, if you put it that way. Say, how come we are not able to attract, not even Ghana, Mozambique is attracting a lot of international capital into their markets. And what's happened right now in Zim is we're actually losing capital. And we are losing capital at the level of portfolio investment, where on the stock market, there's a lot of money that's moving out on a monthly basis. These are guys that have trusted Zim as an investment destination for so many years, who are feeling frustrated that over the years value has been lost on account of the policy framework, whether it's to do with the change in the currency, and also the failure to be able to moving funds from Zim into their markets. So those are things that we need to try and address and make the country attractive to investment. Otherwise, there's no meaningful development that we can do actually for the economy our size without any international capital coming into the market. And maybe jumping to the issue regarding the markets, the past 6 months has been very good for the market if you're just looking at the returns that we achieved on the Zimbabwe Stock Exchange. It was a very fruitful period, actually. So if you look at the last quarter alone, the all-share index was up almost 40%, 38%, being driven mostly by your small and mid-cap counters. There was a lot of activity on the market. I think most of that was being driven not because of anticipation of improving macro fundamentals, but concern and worries about the liquidity situation. So when more money is being created into the economy, to the magnitude that we have seen in the last 6 months, that money has to find some home, and we have got some very limited options. So the most feasible option was the stock market. So most of that money was coming onto the market, hence driving the market to level where it is. I mean, the market at around $5.7 billion US by market cap, it just tells you that in a setup where the economy hasn't really improved that much, it just tells you it's more liquidity driven as opposed to the outlook. Because when you're looking at the status or the state of the listed entities right now in terms of their production numbers, they are probably at less than 40% of their recent peaks around, say, 2015, 2016. And whenever there is a reduction or maybe a slowdown in the liquidity coming onto the market, you also see that. So in the first week of July, the market sort of slowed down, so linked again to the whole liquidity issue, but also to a certain extent the lockdown measures and the worries. The outlook, we still think that the market is going to be driven mostly by the liquidity. There's so much money coming from all angles. Also, the payments to farmers, be it in maize and other critical crops that are not US dollar denominated, but also all these other projects that we are trying to fund internally, infrastructure projects that we are trying to fund internally, and the whole drive of being food self-sufficient. We know that a massive investment is going into wheat production, for example, and most of those resources are being generated internally, and basically it's not like it's being generated in the sense, it's basically money that's being created, that's coming onto the market. So the market is expected to still be quite firm, but being driven by the liquidity as opposed to the general positive outlook of some of these listed companies.
Okay, gentlemen. Thank you, Rufaro and Ranga, for taking your time to come and share with us your remarkable views. And to our viewers, thank you for staying tuned. Please use the details displayed to share your comments and views. See you next time.